Hey everybody, Jim Ingersoll here with the Real Estate Success Podcast, hanging out with a very good friend of mine, James Bryant. James, how are you today?
Hey, my name is James Bryant, and I choose to be happy. How you doing,
Yes,
Jim?
love that about you. What a great way to get started. And all of our success listeners today are going to love this show, and you're going to be encouraged, you're going to be inspired, and you're going to learn so much about investing in multifamily. James was on our panel at Dealmaker on the multifamily and hit a home run. Everybody wanted to meet you at Dealmaker, James. Everybody came up to me and they're like, how can I meet James?
Jim, first, as I told you personally, and I'll tell you publicly, thank you for giving me the opportunity to come to the event, to be on that panel session. It was great exposure for me, and I really want to be able to add value to the people in your network, as well as the people that were there at Dealmaker Live 2020. I'm looking forward to Dealmaker Live 2021. Hopefully, I'll get a chance to participate in that as well. And you're absolutely right. There was a lot of interest in multifamily, although a lot of people that were there, were private lenders, fix and flippers, buy and hold, single family rentals. But there was a lot of interest in multifamily, and I appreciate the opportunity to be able to speak with that group.
I love it. Now, of course, we both go to the same church, but we really got to know each other serving on the board at our church.
Mm-hmm.
And that's where we got to know each other. And I'm like, the longer I get to know you, you're such a humble guy. I've got to figure out all the pieces of your backstory. I just realized in the last 60 days that you're a civil engineer, you're a PE, you're a doctor, you got a PhD.
Yes.
You got all these advanced degrees. Your wife's an amazing dentist, of course.
Mm-hmm.
Let's go back to the beginning. Where did you grow up, James? And
okay.
What led you to going to school to get that civil engineering degree anyways?
Well, I grew up in Philadelphia, in the inner city of Philadelphia. That's where, I was born, where my family was at. And I was a pretty smart kid, but again, we grew up in poverty. I didn't know that we were poor because everybody around us were poor, and we tended to be doing better than those around us. At least that was my perception at the time. I really didn't understand, the depth of our poverty until it got time to get ready to go to college. And I'm like, okay, guys, I'm ready to go to college. How are we going to pay for this? And, my parents are like, we don't know. And so I started out at Drexel University. I was able to go there, and I was majoring in commerce and engineering, which was business with an engineering background.
Love it.
Eventually, I transferred down to North Carolina Agricultural and Technical State University in Greensboro, North Carolina, to finish a degree in civil engineering. So I have my bachelor's in civil engineering from North Carolina A&T, and I have a master's and a PhD in civil engineering from Virginia Tech.
Wow. So we're talking to a doctor here, folks, but he's got a heart of gold. And so, okay, so then you got your engineer, I'm an electrical engineer, so don't hold that against me. So we're both recovering engineers.
Yes.
Awesome. But what did you do after you got all those degrees?
Well, typically when you get your PhD, you're either going to do postdoc research or you're going to go and teach at a university. But one of the things that really bothered me about graduate school is some of the professors were there teaching, but they had no real world experience. And so for me, it was a quest to get real world experience. So I left, got my PhD. I went to work for a company that was managing maintenance on roadways and bridges. I requested to go out and work with the field crews for the first couple of months that I was there. So working with the field crews, we're removing dead animals from the road, digging ditches, cleaning ditches. There was a hill slide that we had to fix, and we're down there with a lot of mud and moisture and snakes and all kinds of stuff. But for me, it was important to make a connection with the people that I believe that I would be leading one day. And if you don't have that connection, I think sometimes it's hard for you to understand and relate to really be an effective leader. And so I started there. I went and worked in that company's central office for some time. And then I had the pleasure of going to work on one of the urban street projects in Washington, D.C. So I was in Washington, D.C. for this company. working, managing maintenance on roadways and bridges there. In 2003 or so, got married,
All right.
and my wife, she's here in Richmond. So I moved to Richmond, and I actually got a job working for the Virginia Department of Transportation. I worked a little bit there in the Transportation Research Council, and then I worked in the central office where I was managing the contract maintenance unit. Did that for a couple of years, and then eventually made my way back up to Washington, D.C. to work for the Transportation Research Board, which is whom I work for now.
All right. That's a great place to talk about having a W-2 income and investing, right?
Yes.
It's a good thing. It's not a bad thing. So how do you manage that? Because you're buying like apartment complexes in like North Carolina and stuff, but you're working full time for the government. And is it tricky? Is it intensive? I mean, how do you like manage all this work-life balance stuff?
Ooh, man, that's an excellent question. I think the primary thing is the things that I do are part of who I am. And so it's not necessarily something that I just do. So
Yeah.
I'm not, there's a reason why I'm investing in multifamily real estate, primarily to be able to make an impact on people's lives. I recall the first time that I went on a property inspection, and we're expecting the units. We're going through, there's a young lady who's there. She has 3 kids. 2 of them are still hip huggers, and they don't have any working water downstairs. And the sink is clogged up. There's mold coming down from the ceiling because there's some type of a leak coming from the bathroom upstairs. And it really broke my heart to be able to see the conditions that they were living in. And I knew at that time that, yes, I want to make a profit. Yes, I want to build generational wealth for my family, but I also believe that I can make a difference in the lives of the residents that are there. So part of who I am, thank you for mentioning that you believe I have a heart of gold. But it's really all of these, but all of these things are just an outflow of who I am. So in terms of finding that balance, it's really being able to manage your time adequately and with integrity, and being upfront about what your priorities are and what you're doing work-wise, what you're doing investment-wise, and just continuing to move forward in that way. So I don't view it as finding time to be something external than who I am.
And we should probably talk about core values in a little bit, but back to like having this mission as part of your why. Like it isn't just that you're a greedy person. Like you want to make an impact on people's living conditions.
Mm-hmm.
Do you think that helps you be a more successful real estate investor doing multifamily?
I do. I think the path that we've taken may be longer, but I think it's a very fulfilling path when you're able to make an impact on people's lives while you're building that generational wealth. It's an awesome feeling. And, some people will say, okay, well, why don't you generate the wealth and then make an impact? Well, a lot of people, when we function that way, we don't always come back and do the things that we say that we're going to do. We're saying, I will make an impact if I have, X amount of dollars or X amount of properties, or once I get to this stage, I can make an impact. I believe that you can make an impact wherever you are. In that if making an impact is a core value for you, then you'll figure out how to make that impact at whatever level you can, wherever you are. Start where you are now. Don't wait.
That's a great point. So let's talk a little bit more about core values, because we have very similar core values: family, faith, integrity, character. Talk about how those guide you on a daily basis and how they help you on your road to success.
Okay. I think part of that is, when you start really looking in the mirror at yourself. So I've started this type of work a long time coming.
Yeah.
And you have to be able to see the parts of you that you like and the parts of you that you don't necessarily like as well. And you have to be able to accept yourself for who you are. And when you accept yourself for who you are, that doesn't mean that you won't change or that you don't need to improve, but you're just saying flat out, this is who I am. This is the characteristics that I have. Here are the things that I do. This is what I'm about. Once you get to that point, then you start integrating those things in your life where you change, where you really begin to evolve and you begin to improve. So for me, those core values, I take what I call a centered approach. I don't believe in the whole concept of work-life balance. And the way that I describe it is if you're looking at a balance and you have, say, for instance, your family or your relationship with God is what's most important to you. If that's on one end of the balance, then there's absolutely nothing that you should be able to put on the other side that will influence the depth of what that is, that core value is for you. So for me, I look at a centered approach. So I move those things that are important to me as part of my core and they're the center of who I am. And then, from that center, I begin to also affect the lives and impact the lives of those that are further out from me.
Love it. All right. So that is great because I think it's important to understand your why, your mission, your core values for your business, but also for your own life. And all that sort of ties together and allows you to be successful in what you do, which is for you is multifamily in the real estate world. Talk to me about how you sort of got started in real estate investing and ended up in multifamily and how you sort of like put the pieces together to do that first deal.
Okay. So many years ago, when I first got married, I remember talking to my wife, looking at some apartment complexes, small complexes, and saying, "Hey, man, it would be really cool if we could do this." I remember talking to my mom one day, was saying that, "Hey, Mom, I think I really want to do some kind of investing. I want to do something in multifamily." She's like, "Oh, yeah, baby, you'll be able to do it. It'll be fine." So, but that was like 15 years ago.
Mm-hmm.
And, it started off with that thought. And then the interim, I really didn't give it much thought. We're in the process of starting a family, getting our own house, developing our careers, kind of moving forward. And we were in a position, what I would call income rich, but cash poor. We were making good money, but we didn't have a lot of money saved. We had a lot of other demands on our resources. And so as time passed, that began to shift and we were able to pay things down. We were able to have a little bit more flexibility. And then it was like, hey, why don't I start thinking of, I do remember I thought something about multifamily. So why don't I think about, real estate? I really didn't want to give up my full-time job. I like the organization that I work for. So that's not, I didn't want to go into, I didn't want to leave one job to create another full-time job.
Right.
That was not in the cards for me. So I started to look at other opportunities, and I had a really good friend, Jerome Myers, that I've known probably for a good 12 years now. We knew each other from different alumni board activities from North Carolina A&T. He also went to North Carolina A&T, but our span of difference is probably about 8 to 10 years from when we were there. And he came and he was like, "Hey, I have an interesting opportunity for a multifamily deal. What do you think?" So I looked at the information, began to evaluate it, begin to dig underneath the numbers and say, well, how did you get this? Why are you projecting this? And it really did intrigue me. So I partnered with him on his first multifamily deal. And then we began to branch out and do more joint ventures in North Carolina. In the first deal that we did, it was with a group of folks that were here in the Richmond area. But the first deal that we actually put together as a joint venture, he and I as partners, was a 20-unit property in Greensboro, North Carolina. And actually, we were able to find that property through a mailer.
Nice.
So, we mailed different property owners that were in that area. We got a response, began to start talking about negotiations, and things began to fall into place. We basically worked through our own networks, kind of family and friends
Yeah.
and people that had an interest in multifamily investing. And we partnered with them. So all of the deals that we've done to date have been joint ventures. And so all of the partners are all active. So, we don't have any passive investors in those deals. But it was a model for us to be able to get the experience that we needed, one, putting the deals together, but also running the properties.
Okay, so a lot of people talk about doing acquisitions of multifamily with syndicating. You did it with this joint venture model. Can you just tell us sort of roughly how that JV model worked for you guys? And have you evolved it, or you do it sort of the same way still?
We do it sort of the same way. Basically, you have your, each property has its own LLC, and there is some holdback for the management team that's putting together all the deal information together. And then the equity pieces are coming into that LLC that'll pay for the down payment and the initial maintenance
Capital
reserves.
contributions.
Mm-hmm.
Okay. So you raise money with your joint venture partners for the down payment.
Mm-hmm.
And you find a bank that will finance it, and you use the privately raised funds in the LLC to fund the down payment.
Yes.
More or less, right?
Yes, that is correct.
Okay. And then are they typically already rented and sort of cash flowing? Do you need to do improvements? Do you do value adds? Do you have a property manager? How does your system usually play out?
Usually they are, well, you asked the question.
I did a lot of things. Sorry.
Yeah. No. I was laughing because it's like similar to a question that was asked at the Dealmaker 2020 Live, when it's like, are they rented? Well, in all of the paperwork that we get before we take ownership, yes, they're all rented. It's, you're looking at 80%, 90% occupancy. But then when we begin to dig deeper into the numbers, there's a difference between what's in the pro forma and how many people are physically occupying the units and how many people are economically occupying the units, meaning are they paying rent and have they been paying on time? So typically what we find is the properties are underperforming. So they lack some tender love and care.
That's a fixable problem, right?
Yes, it is a fixable problem. We have not.
You want that if you can reflect it in the price. So go ahead.
Yep. So we have not done, at least on the projects that we've had in Greensboro, they have not been heavy value add. Okay. It's been more operational improvements. As the leases come up, we do a light renovation, and then we continue to improve the exterior of the property and continue to address the needs of our residents. And through that, we're able to force appreciation, because it does. I mean, the reality is it does cost money to run the business. It costs money to address the maintenance issues. It costs, money to make sure that things are done the right way. And what we're finding is that as we treat our tenants right, then as we begin to have those rental increases, we're not having huge turnover just based on the rental increases. Some of the turnover is just, it's time for some folks to leave because the quality of the tenants are changing. It's changing. The mix of tenants are changing.
And are you guys using a property manager? I mean, you don't self-manage, right?
No, we don't self-manage. We use a property manager, and we also have an asset manager. So in the case of the projects that we have in Greensboro, Jerome Myers serves as that asset manager. So he manages the property manager. Any other kind of repairs that we need, he takes on that role and makes sure that he's managing that. And for the other partners that are involved on a quarterly basis, we have our quarterly meetings, but on a monthly basis, we're looking at all of the details of what's going on in that property and coming together to make decisions as to what are some of the operational changes that we need to make. If not, we're fine. Let's keep going down the path that we're going. So that's typically how it's worked for us.
Okay, I love it. That is great. Looking back, what do you think the biggest challenge with jumping into multifamily would be? Is it finding the deal, figuring out the financing? I mean, what do you sort of see as some of the challenges?
I think it's the first challenge is believing that you can do it.
Ooh, boy, it starts up here.
Yeah, it starts there. You have to believe that you can actually do it and that it's not bigger than what you can achieve. I think that's the first thing. If I think back to 15 years ago when I was thinking about getting into real estate investing, I had no clue. I'm looking at stuff, I'm looking at data, but I don't have any clue as to how to execute. And so it's understanding that when it's not bigger than you, there are resources that are out there that are available that can help guide you along the way. When it comes to the financing in general has been pretty simple for us. So the financing part, when you have strong W-2 partners, you're able to go and get bank financing. So we've been able to do all of our deals through traditional commercial bank financing. The hardest part for us has been making sure that we're able to raise the initial money for the down payment and any initial repairs and reserves that we need. We bought the second property that we purchased in Greensboro. That one was, okay, I'll go back. The first property we purchased was about a little over $800,000.
Okay.
The second property that we purchased was listed at 1.5. We got it for 1.3. And, for some folks, those numbers don't seem big. And at this point, they're not large to me now. But at that time, they were huge.
7 figures. There's a lot of zeros there, and you can't. You've got to believe, and to go back to your belief statement, that you're good.
Yes, you have to. And so we struggled raising the resources to be able to close that deal.
Sure.
And Jerome and I were talking, and we said that, you know what, this is not going to happen to us again. We are going to do something different so that we are not in a situation where we're getting close to close date and we're like, I don't know what we're going to do. And so we kind of promised each other that we weren't going to be in this position again. And so for us, what that meant is getting out there, making ourselves known, more or less, building a network. As you will say, your net worth is your network. And just making sure that we're able to build a community of like-minded people that have the values that we have. We started an online multifamily investing course.
Yep.
And we had, let's say, 13 participants in that course. The first cohort just finished. Nice. We're planning on celebrating them in March 20th through the 22nd, where we have the Mid-Atlantic Multifamily Investing Conference, which is a conference that Jerome and I are co-hosting that's really going to bring together owners and people that are owners and operators and investors in multifamily projects that can talk about their process and their journey.
And that's March 20th to the 22nd. It's in Greensboro, right?
Yes, it's in Greensboro, North Carolina.
I've got a link in the show notes here, but it's myersmethods.com. If you're listening in iTunes, myersmethods.com, you can go over and pick it up over there.
Mm-hmm. And so that's all part of building that community so that we can tap into our network as opportunities arise. Sure. And also that we can see where we can add value to that network, because it's not just about what we can get, but it's about what we can give.
Yeah.
So we also have a monthly virtual multifamily real estate meetup.
Nice.
And so we just do that virtually, and I'll make sure I get you the information.
Yeah, please. I can help you guys with that. So that is awesome. Let's go back to due diligence, and maybe we can end with this last point on due diligence.
Okay.
you mentioned that you receive a rent roll, you get pro formas, and everything looks really good. But that isn't always reality, because just because there's a lease doesn't mean they're actively paying. And just because you get a list of expenses from a seller, he may fudge them, or he may not be accurate. Do you guys find there's like, are you able to just like ballpark and just say every apartment complex is between 30 and 40% expenses? Or do you really dig down on every one of them and just say, and hope for the best, but plan for the worst, so to speak, on those details of due diligence?
It's a combination of the two. If we're going to make the initial letter of intent where we have the information that has been provided, we may ask for the T12s, looking for more detailed information that can give us what we need to be able to make an initial offer. This is our intent. We want to purchase it at this price. Of course, that's all contingent on the due diligence information that we receive.
Right.
So that ballpark is kind of used to get us started. But each property tells its own story, and the story is in the numbers. I mean, you can go look at it, and you can see the results of deferred maintenance, both financially and physically in the property. And so if a person has been running the property and they say that their maintenance on a multifamily property is less than 30%,
right,
something's not quite right in those numbers, or they've been really, really lucky that they've had nothing kind of blow up on them. But each property is different, and you have to see, is the owner providing utilities?
Are you like factoring in your head like 30% for maintenance, something for like, if they show less than say 35 or 40% total expenses, would that be a red flag?
Yes, it would be a red flag. It doesn't mean that it's a no-go.
Right.
But it means, hey, we need to make sure that we dig into the details to see exactly how they're achieving what they say they're achieving.
And do you have like a worst case, like, it can't be any worse than this? I know I don't have accurate information from this owner. It can't be worse than 40 or 45%. Do you ever do that?
No, it's, we don't do, it can't be worse than 40 or 45%, because we know and have experienced that it can be worse. Particularly when you have to factor in the vacancy issue.
Yeah.
So it's not just, when you're evaluating, you're looking at the numbers, but you also you got to get back to the economic vacancy, the economic occupancy rather. And, is it economically occupied? And so it's finding the balance between those two and to help you make your offer. So what typically happens is that we get the numbers, Jerome runs his analysis, and I run a separate analysis. So we both separately do the financial due diligence and come up with underwriting for that. I'm much more conservative, right? So I'm like, these guys are crazy. They'll never get that. So we need to offer some lowball number. Jerome is a little bit more realistic in terms of what things are trading for in that market. And so we eventually come together and talk about each of these issues, each place where we had a difference of opinion, a difference of philosophy. We talk through that so that we can both have a better understanding of the number that we finally use and that we come up with to make our offer.
And do you look at like future rents? Because a lot of times stuff's under rented. I'll give you a drastic example, which is one I recently did, which when we bought it, the exact apartments were renting for like $500 a month. Mm-hmm. After we rehabbed and renovated, and we got $1,500 a month. So do you also like figure out like what is the market rent and what does that property need to look at, and how much capital does it take to get there?
Yes.
So you buy for current results, but you have to look forward as well, right?
That is correct. We buy things that are, according to the numbers, cash flowing, right? Everything's it has to cash flow, even at the new purchase price and the debt service. It has to cash flow. Number one. And so all the projects that we've had to date, particularly in the Greensboro market, have all cash flow. So that has not been an issue. But we do look at what is the market rent, and what do we need to do to improve the property to be able to achieve market rent. So a lot of those places are not necessarily under rented or under market. They're at what the market will bear for
Yeah,
the quality of
I
place
agree.
that's being provided.
Well said.
And so as we begin to improve that quality, then you have the ability to attract better or different renters.
Right.
And from there, you can force appreciation. So we absolutely look at, you know, how we can raise those rents. So the one we purchased in the first complex we purchased in Greensboro, the rents were like at 500. And now the new rentals are 685.
Right. That's a big improvement. That really helps your cap rate, which improves the value of the overall apartment
Mhm.
complex, right?
That is correct.
That is where you really get that equity gain piece. It's like the cash flow holds everything together, but if you can do value add or improvements, then you get more rent and higher occupancy, like you said, operational excellence and things like that. And then all of a sudden, the whole thing's worth a lot more.
Yes.
In your position, if you choose to resell or refi to get your cash back to go do it again.
That's the play. The general game plan is that you take ownership of the property, you improve it through operational improvements, through small value adds, increase the value of the property, because a lot of people don't realize that for multifamily, it's basically valued on the value of that business. How well is that business running, and what is your net operating income? So as you're able to increase your net operating income by continuing to increase rents and reduce expenses, then you have created value within that property. So the model that we typically use is within 5 years, we want to be in a position where we can refinance and provide all of our partners their initial capital back.
Yeah.
And so we're getting in the 2.5 year mark, and we believe that we're almost at that position for that first property that we purchased in the Greensboro market.
Excellent. Well, we covered like the whole cycle today, and I really appreciate it. I got to respect your time too, because this went a little longer than normal, but I'm hanging out with my buddy. So
yeah, man. No, thank you. I really do appreciate the opportunity to talk on your platform, to kind of connect with you in a different way. So it's really awesome. Jim, you're a great guy, full of integrity, and I just appreciate the person that you are.
Hey, I love your faith. Let me just say, in your family, you got an amazing family, and your faith and your heart is heart of gold. And so I just love you guys to death, and can't wait to see you back at West End Assembly of God again and hang out with you some more. March 20th to the 22nd, go to myersmethods.com. Join us in Greensboro. You're going to learn so much. Thanks again for participating in Dealmaker, James, and congrats on everything, and good luck with everything going forward.
All right. Thank you, Jim. I appreciate it. All right.
Thanks, everybody, for tuning in, sharing, reacting. Leave me your comments, and we'll answer them. Have a great day, everybody.